So what's the progressive tax rate? That's a question that we don't think a lot about is our taxes. But reality is, over the course of your lifetime, you're going to pay 50 to 60% of your income to taxes. Think about it. Between federal taxes, state taxes, excise taxes, sales taxes, a fair amount of your income, if not the majority of your income, is going to go toward the tax system, which is basically our elected officials redistributing our income. So that's how it works in a capitalist, free society based on our Constitution. But bottom line is, this isn't a civics video, but it is how the tax system works. Now, another feature of our tax, so you want to know about taxes. I mean, that's always been a big point that I make to my classes is, even if you're not an accountant, you have to know how the tax system works. I mean, you might, always pays to have a great accountant, no question about it. The more complicated your taxes, the more you should rely on expert tax advice. I'm a firm believer in that, but you should know how taxes work. You shouldn't, the idea that people get their tax number at the end of the year like it's some lottery ticket, oh my God, I owe this, is ridiculous. I mean, a person should be aware of where the money's going and what's been taken out during the year and how much they can either owe or get back. So taxes and understanding taxes are really important. But at any rate, before I digress too much, how does a progressive tax system work? Well, progressive tax system is really, the word progressive is the more you earn, the more you pay. There's been a lot of arguments, and you'll certainly hear enough of them during an election year about how taxes are arranged. But let's just talk about how a progressive tax system works. It means that everybody is not taxed equally, right? If we had one singular tax system, we say it's a flat 20% tax, then everyone's income would be taxed at 20%. That kind of would be not productive and sort of unfair, because there are people certainly that could use the extra income if their income levels are lower. So again, these tax systems don't just come out of thin air. We elect our officials, they agree on a tax structure, and obviously if the people weren't happy with that tax structure, they would elect new officials. So this is an outgrowth of a free democratic capitalist system, where we elect the officials who put the tax system together, and then they create a progressive tax system, or they enable a progressive tax system, and obviously we're in agreement. So, so how does it work? I mean, it depends on your income. For the first 83, and obviously this is a simplification. There are tax credits, there's money that you could save by putting money into retirement accounts, there are education credits. The government offers all these different credits to us to encourage us to do different things. Like, for instance, you go back to school, you get an education credit. If you have dependents that you're taking care of, you get credits, you get deductions for that. If you the tax system has been simplified somewhat by giving us a standard deduction. We have a standard deduction that's approximately $14,000 for a single person and $28,000 for a couple. So we don't need to itemize our taxes, but obviously if your taxes are higher, you can itemize and take a bigger deduction. Again, this isn't a total tax seminar, but I just want to give you a general overview. But how does once you've done all of that, how does it work? Well, the first $8,300 of income is taxed at 10%. From $8,351 to $33,000 is at 15%. So just by looking at this, and I borrow this from Investing Answers, notice that as your income rises, you get taxed at higher and higher rates, and that's called the marginal rate of taxation. And we know in accounting, and in economics, marginality is crucial. Marginality means and you really need to understand the concept of marginality. Marginality asks us, what is the next thing? On the margin, with the next decision, how does that affect my income? So we always want to think about that as economists. So for instance, if I'm making $82,000, I'm right here at the cusp of this 25% tax rate, and I'm offered an opportunity to increase my income with either more work or a new job or a new project. The question is, I have to figure the new project based on the progressive rate, 28%, because I won't be taxed at 25 anymore. A business person or a smart person would say, well, now if I take on the extra work, I'm going to be taxed at 28%. So you see where the tax rates are very important. Because in the past, we've had marginal tax rates as high as 90%. And the argument there was, well, at 90%, I'm not going to do much more work because I'm not getting enough out of it. So that's why it's really important that the government calibrates how the marginal rates work. But notice and really pay some attention to how your tax rate goes up as your income goes up. And then you just average them. So if you had, say 170,000 of income, you would average the 10% income, the 15% income, the 25% income, and eventually the piece of the 28% income, and you're going to get an average tax rate. So that's something you might want to do on your own one day, just to, you could do it very simple. Just look at your tax filing and look at how much you paid, and look at it versus your income, and that's your average tax rate. But you got to also pay attention to all your deductions and exemptions, and you should know about all the credits that are available before you do anything. One last point on the progressive tax rate. It also relates in economics to different concepts. So we know that there's a famous, we'll be talking about in other videos, the Laffer Curve. And the Laffer Curve is the relationship of taxable income that goes into a government versus its tax rate. So what Arthur Laffer did was he came up with a very novel approach, and it was used during the Reagan administration. And what it did was it told us that, let me see if I can pull up an image. It says, basically, the Laffer Curve says that if rates are too high, I'm not going to collect any tax revenue. And if rates are too low, I'm also not going to collect any tax revenue. That there's an optimal amount of taxes that create the maximum amount of revenue. In other words, we get back to psychology. If I charge people too much tax on a marginal basis, they're generally speaking, and it's all generally speaking, they're going to stop working. They're not going to see the benefit of putting more time in. And if I don't charge enough, well, I'm not going to collect anything as a government. So somewhere in the middle, and we've found that about 32 to 33%, some sort of average marginal rate results in the maximum amount of tax revenue. It's just enough where the citizens feel it pays for me to work harder because I keep enough of my income. It also is the optimal place for the government to collect the most income. And like everything else in economics, like the pricing system, we're always looking for that optimization, that place where psychologically a person feels it's worth working harder because they can't keep enough of their income, and the government feels this is enough income for us to run the government, frankly. So this is a good overview of the progressive tax system, and we also introduced the Laffer Curve.